Everyone thinks crypto's biggest risk is the price. It goes up, it goes down. You either got in early or you didn't. That's the story everyone's comfortable with because it's simple and because it's the story you can actually see. There's a chart, it moves. You either made money or you didn't, except that's not actually where the danger lives. The danger isn't the chart, it's what's sitting underneath it, quietly, in places almost nobody bothers to look. Because right now, billions of dollars in crypto are being lent, restaked, and rehypothecated through a system that has almost no name recognition, no deposit insurance, and no regulator watching the whole picture at once. Most people holding crypto have never heard the word rehypothecation in their life. Most people staking their coins for a bit of extra yield have no idea their asset might be quietly backing 3 or 4 separate obligations at the same time. And most people holding what they think is the safest, most boring corner of crypto, a stablecoin, have no real sense of what's actually sitting behind that coin, or what happens if a large enough group of people ever try to cash out at once. And we've seen this exact structure before, not in crypto, in 2008. Back then, an economist named Paul McCulley stood up at a conference and warned about something he called the shadow banking system. Institutions that borrow like banks and lend like banks, but aren't actually banks. No FDIC insurance, no Fed safety net, none of the rules written for real banks. That system helped take down the global economy in 2008. It cost millions of people their homes, their retirement savings, their jobs, and it took the better part of a decade for the damage to fully clear. And right now, in an industry most people think is too new to have old problems, that exact same structure is running again, just with a different name, a different asset sitting at the center of it, and a new generation of people who've never heard the warning the first time around. So let's actually build this from the ground up, piece by piece, because once you see the shape of it, you will start noticing it everywhere in crypto. It's in the lending platforms that collapsed in 2022. It's in the restaking protocols that have exploded in size over the past 2 years, and it's sitting quietly underneath the single largest and most trusted asset in the entire industry, stablecoins. McCulley wasn't describing a conspiracy. He was describing plumbing. The shadow banking system he warned about wasn't one company or one scandal. It was a whole category of institutions doing bank-like things while wearing a costume that let them skip every rule written for actual banks, money market funds, mortgage securitizers, off-balance sheet vehicles holding trillions of dollars in assets that almost nobody outside a handful of trading desks in Manhattan actually understood. Not the regulators overseeing the system, not the ratings agencies stamping these products as safe. In many cases, not even the executives running the firms that owned them. When housing prices turned in 2007 and 2008, that entire hidden layer unwound in a matter of weeks, and it took the visible economy down with it. Because by then, the shadow system had grown larger than the regulated one it was sitting quietly next to. At its peak, shadow banking assets in the United States were estimated to exceed the assets held by the entire traditional, regulated banking sector. Think about what that actually means. The part of the financial system with the fewest protections had become bigger than the part built specifically to survive a crisis. And when the crisis came, it came for the part that had no airbags installed. Here's how a normal bank works, and it's worth walking through slowly, because the entire rest of this video is just the same idea, stripped of its safety features. Wearing different outfits, you deposit $100 into your checking account. The bank doesn't just let that money sit there in a vault with your name on it. It lends most of it out to someone buying a house, someone starting a business, someone financing a car, and it keeps only a small cushion in reserve. In exchange for letting the bank use your money this way, it pays you a little interest. That's the entire business model. Borrow cheap from depositors, lend out at a slightly high rate, pocket the spread. The obvious problem with this setup is that if everyone showed up at the same branch on the same day and asked for their $100 back, the bank literally could not pay everyone. The money isn't sitting there. It's out the door, tied up in a 30-year mortgage or a business loan that won't be repaid for years. That's called a bank run, and it used to be one of the most common and most destructive events in American financial history. Entire regional economies would collapse because a rumor spread and a line formed outside a bank that genuinely could not survive it. The reason banks mostly don't collapse this way anymore isn't because banks got smarter or more careful out of the goodness of their hearts. It's because of decades of rules built specifically to prevent it. Deposit insurance through the FDIC means your money is protected, even if the bank fails, up to a certain limit. So there's no rational reason to panic and run in the first place. Reserve requirements force banks to keep a meaningful cushion of cash on hand rather than lending out every single dollar. And a central bank, the Federal Reserve, can step in as what's called a lender of last resort, providing emergency funding to a struggling but fundamentally sound bank so a temporary panic doesn't turn into a permanent collapse. All three of these things exist because in the 1930s, and repeatedly before that, the country learned the hard way what happens without them. Now take that exact same mechanic, the same basic idea of borrowing from one group of people and lending to another for a profit, and strip out every single one of those protections. No deposit insurance, no reserve requirements, no lender of last resort standing by. That's crypto lending. And to be clear, none of this requires anyone at these companies to be a villain twirling a mustache in a darkroom. Most of it starts as a genuinely useful idea, and it's worth giving that idea its due before we get into how it broke. People holding crypto want to earn something on it instead of letting it sit idle in a wallet doing nothing. That's not an unreasonable want. It's the same instinct that makes you put spare cash into a savings account instead of a shoebox. Someone builds a platform to match those holders with borrowers who want to use that crypto for trading or leverage. On paper, it's just a marketplace, a matchmaking service between people who have an asset and people who want to borrow it. The problem only shows up once you ask what happens on the worst possible day. What happens if the borrowers can't repay? What happens if the collateral backing those loans crashes in value faster than anyone can sell it? What happens if a huge number of depositors want their coins back at the exact same moment? And in 2021, he was asking that question because the good days were so good that asking felt like ruining the mood. Prices were climbing, yields were high, new money was flooding in every single week. Asking, but what about the worst case? In the middle of that felt less like due diligence and more like being the one person at the party checking their watch. In 2021 and into early 2022, platforms like Celsius, BlockFi, and Voyager offered something that sounded almost too good to check twice. Deposit your Bitcoin or Ethereum. Earn up to 18% a year. Compare that to a traditional savings account paying 0.5%, maybe 1% if you shopped around. And it's not even a hard sell. It sells itself. Celsius alone grew to hold more than $25 billion in assets at its peak from more than 1 million customers, many of whom weren't sophisticated crypto traders at all. They were regular people who'd heard a friend mention it, or watched a video, or seen an ad and thought, why would I leave my money earning nothing when I could earn 18% instead? But almost nobody was asking the obvious question, where does 18% actually come from? Because in finance, yield doesn't fall from the sky. It comes from somewhere, and it usually comes from risk that isn't being shown to you clearly, wrapped in language designed to sound safe and boring instead of exactly what it is. The answer was the same one banks have used for centuries, just without any of the guardrails. These platforms took your deposit and lent it back out to hedge funds, to trading firms, to other platforms, chasing high returns to cover the yield they'd promised you. It's the exact same spread lending business model at bank runs, except unlike a bank, there was no reserve requirement forcing them to keep a cushion of your deposit on hand, no insurance covering your coins if it all went wrong, no regulator checking whether the loans they were making were actually safe, or whether the borrowers on the other end could realistically repay them. You were handing your coins to a company that was functioning exactly like a bank. Structurally, mechanically, in every way that mattered, while legally being nothing like one, and carrying none of the protections that come with it. And then came the moment that broke it. In May of 2022, a project called Terra and its algorithmic stablecoin, USD, collapsed in a matter of days. USD was supposed to always be worth $1, maintained not by holding actual dollar reserves like Tether claimed to, but by a complicated algorithmic relationship with a sister token called UNA. It worked right up until it didn't. One's confidence cracked. The mechanism that was supposed to hold the peg in place instead accelerated the collapse, and roughly $40 billion of value evaporated in less than a week. It remains one of the fastest and most complete destructions of value in modern financial history, crypto or otherwise. And because these lending platforms were all quietly connected through the same pool of borrowers, the same handful of trading firms, the same collateral being reused over and over across the system, the damage didn't stay contained to the people who'd actually held Terra or UNA. It moved like a virus through the entire ecosystem, infecting institutions that had never touched the project directly but were tied to it through 2 or 3 degrees of counterparty exposure they didn't even know they had. Celsius froze customer withdrawals in June of 2022, telling more than 1 million depositors without much warning that they could no longer access their own money. Voyager followed shortly after, freezing withdrawals and eventually filing for bankruptcy. 3 Arrows Capital, a hedge fund that had borrowed enormous sums across nearly every major lending platform in the space, often using the same collateral pledged multiple times over, imploded entirely and took a piece of every one of its lenders down with it. Genesis Global Capital, a major crypto lending arm connected to some of the largest names in the industry, halted withdrawals too, citing exposure to the same unraveling counterparties. By the end of that same year, FTX, one of the largest and most trusted exchanges on Earth, backed by some of the most respected venture capital firms in the world, collapsed as well, revealing that customer deposits had been quietly funneled into a sister trading firm called Alameda Research the entire time, used to plug holes and fund risky bets that had nothing to do with the customers who trusted the exchange with their money. This is the part that should sound familiar, because it's the identical failure pattern from 2008, playing out with different assets and a compressed timeline. One institution overextends, gets caught holding assets nobody wants to buy at the price they're marked at on paper, and the panic spreads to every counterparty connected to it, whether or not those counterparties did anything wrong themselves. In 2008, it was mortgage-backed securities that nobody could accurately price once housing turned. Ratings agencies had stamped them safe. Investors had trusted those stamps. And when the underlying mortgages started failing, nobody could agree on what these securities were actually worth, which meant nobody wanted to buy them, which meant institutions holding them on their books were suddenly sitting on losses they couldn't even properly measure. In 2022, it was crypto collateral that nobody could accurately price once. Terra collapsed and the broader market turned. Same disease, different host, same underlying mechanism of hidden interconnection, turning one failure into a cascade. By the time the dust settled, more than a dozen major lending and trading platforms had either frozen customer funds or filed for bankruptcy within about 7 months of each other. Regulators and bankruptcy trustees later estimated combined customer losses across just the largest of these failures at well over $10 billion, and in many cases that money remains tied up in bankruptcy proceedings years later, with ordinary depositors standing in line behind institutional creditors, lawyers, and various other claimants, fighting to recover cents on the dollar for assets that were worth far more at the time they were frozen. Some Celsius customers, for instance, are still working through court processes years after the platform initially halted withdrawals, watching the value of the crypto they owed shift while their claim sits unresolved in bankruptcy court. Compare that to how a real, regulated bank failure typically works in the United States. When a bank fails, the FDIC generally steps in and ensures depositors are made whole. often within just a few business days, sometimes even the next business day. There's no years-long bankruptcy odyssey for an ordinary depositor with an insured account. That gap right there, the difference between how fast a real bank protects you and how slowly an uninsured platform leaves you standing in line at bankruptcy court, is essentially the entire price tag of skipping the regulation. It's not an abstract cost. It's the literal difference between getting your money back next week or possibly never seeing all of it again. But here's what's genuinely strange about all of this, and it's the part most people watching the headlines in 2022 completely missed. None of this actually stopped the system from rebuilding. It didn't disappear. It just got quieter, technically sophisticated, and in some ways harder to see, because it moved further away from companies with recognizable names and customer service lines and further into code. And to understand how, you need to understand a piece of financial plumbing most people have never heard of, even after everything that happened in 2022. Rehypothecation. Rehypothecation is when a lender takes collateral you've pledged for one purpose and reuses that same collateral for something else entirely, often without you ever finding out, and sometimes even when you technically agreed to it buried somewhere in a document you never read. Picture pawning your watch to borrow some cash. Now picture the pawn shop turning around and using your exact same watch as collateral to borrow money from someone else without giving it back to you or even telling you. And then picture that second lender doing the exact same thing again, pledging your watch to a third party. Your one physical watch is now quietly backing 3 separate loans across 3 separate parties, and if things go wrong, only one of them can actually end up owning the watch. The other two are left holding a claim on an asset that's already gone. In traditional finance, rehypothecation is real and it does happen, but it's tightly regulated. There are legal limits on how many times collateral can be reused, and there are disclosure requirements meant to make sure the original owner has at least some visibility into what's happening with their asset. It's not a free-for-all. In crypto, during the boom years of 2021, those guardrails barely existed in any meaningful way. Investigations into Celsius after its collapse found that customer deposits had been used as collateral for loans, which were then used to chase yield on other platforms, which were then staked again elsewhere, layered on top of layered on top of layered. Nobody, including in some cases the platforms themselves, could say with total confidence how many times a single dollar's worth of crypto had effectively been reused across the system. By the time everything unwound, court filings from the Celsius bankruptcy later revealed something that summed up the entire problem in one line. The company's own terms of service had told customers, somewhere in the fine print, that it might use their crypto for lending and other activities, technically disclosed, buried on a page nobody actually reads before clicking accept. The same way virtually, nobody reads the full terms and conditions before installing a software update or signing up for a new app. Legally covered, practically invisible to the person whose money was actually at risk. And that gap between what's technically disclosed somewhere in a document and what's actually understood by the person clicking accept is where almost every one of these failures ends up living, in crypto and in traditional finance alike. Before I get into where this exact pattern is playing out right now, in 2026, a quick pause, because this next part is exactly the kind of thing that gets missed if you're not paying close attention to your own exposure. If you've ever tried to actually track this stuff yourself, spreadsheets, wallets, 3 or 4 different exchange apps, a cold storage device you plug in once a month and then forget about, you know it turns into a second job fast, which is why a growing number of people serious about this space use a portfolio tool called Delta. Delta pulls your entire crypto and stock portfolio into one dashboard, whether your assets are sitting on a centralized exchange, in a self-custodied cold wallet, or connected to various DeFi protocols. It shows you your real total exposure across every platform you're using, not just the balance sitting in whichever single app you happen to open that day. You can see exactly how much of your portfolio is sitting on centralized platforms versus how much you actually self-custody, which matters enormously given everything we just walked through about Celsius, Voyager, and FTX. Knowing the difference between coins you control and coins a company is holding on your behalf and could theoretically be lending out or rehypothecating right now is one of the single most useful things you can know about your own portfolio. If you're interested, Delta is free to download, and there's a link below to get started. Thank you to Delta for sponsoring this video. Now, back to where this exact shadow banking structure is quietly hiding today. 3.5 years after Celsius first froze withdrawals, after 2022, the industry's biggest lending platforms mostly disappeared or got wound down slowly through bankruptcy court, but the underlying yield-chasing behavior that caused the problem in the first place didn't disappear along with them. It migrated into a corner of the industry that sounds, on the surface, far more technical and far more secure: restaking. Here's the plain English version of how it works. Staking in its original and simplest form is straightforward. You lock up your crypto to help secure a blockchain network, essentially acting as one of many participants who help validate